The global economic data for 2026 presents a picture of overwhelming strength. We are seeing record-breaking highs across major stock indices, interest rate cuts are beginning to materialize, and the expansion of artificial intelligence is pulling corporate earnings upward at a rapid pace. Yet, institutions managing that wealth are issuing severe warnings, tracking sticky inflation, rising consumer debt, and new global tariffs. This creates the central tension. While global growth looks sturdy, the market itself is historically fragile. Almost every traditional asset looks too expensive to buy. For the better part of a decade, investors relied on a period of high returns and low volatility. You could simply buy a broad passive index fund, set it, and comfortably ride the market's general upward direction. Today, that approach faces a math problem. Market gains are now heavily concentrated in just a few AI mega-cap stocks, corporations with market values typically exceeding $200 billion. This level of concentration turns passive investing into a heavy, uncalculated risk. Navigating this paradox requires a shift in strategy. To protect wealth in 2026, investors have to identify the specific fractures forming beneath the macroeconomic surface, rather than relying on broad market momentum. The primary force holding the economy aloft is the AI supercycle, which continues to drive global GDP and corporate earnings higher as other sectors cool. This cycle has moved into the physical world. Companies are now deploying massive capital expenditures to build the sprawling industrial data centers and hardware networks required to support the next generation of processing power. This physical expansion is moving capital into the real economy, specifically supercharging the energy grid, critical healthcare infrastructure, and global logistics networks. This boom has pushed valuations to historical limits. This chart shows current yields in the 92nd and 93rd percentiles. MSCI World measures broad global stocks, while SPX NTM measures expected S&P 500 earnings over the next 12 months. These levels indicate equities are priced at nearly their most expensive point in 20 years. While the AI-driven corporate lift produces real earnings, it masks a difficult reality for investors. The public market has become too expensive to buy indiscriminately. While AI headlines are positive, a microstorm is occurring at ground level of the economy, where individual consumers and workers are feeling the strain. We are in a K-shaped recovery, where different parts of the economy grow at completely different rates. Corporate balance sheets thrive, but the labor market weakens. The bottom half is under pressure as consumers exhaust savings and housing costs rise. New and unpredictable tariffs are acting as a macroeconomic wildcard. These trade barriers ensure that inflation remains sticky, meaning prices resist coming down even as the economy slows. This polarization is complicated by global central banks, which are moving at uneven speeds. As the U.S. Federal Reserve and other institutions cut rates on different schedules, they are creating unpredictable currents in global currency values. Because of this extreme divergence between winners and losers, the strategy of buying the whole market is failing. Success in 2026 requires active selectivity. To find value away from expensive public stocks, institutional money is moving into alternative assets, specifically private credit and large-scale infrastructure projects. For decades, these markets were inaccessible to most. They typically required $50 million minimum investments, locking out everyone except the largest investment banks and funds. In 2026, a technology called asset tokenization is dismantling those barriers. By using blockchain-based smart contracts, institutions can fractionalize a massive real-world project into units of $1 million or less. A smart contract is a digital agreement written directly into code, splitting ownership. This enables instant settlement via stablecoins, digital currencies pegged to the US dollar, creating immediate liquidity. Tokenization provides the mechanism that finally allows a broader base of investors to access the private market yields necessary to balance the fragility of public stocks. 2026 is a world where surface-level tech booms exist directly on top of an underwater whirlpool of consumer pressure and market complexity. In this environment, economic security has become the ultimate portfolio premium. Capital is flowing toward companies that can secure global supply chains, strengthen national defense, and ensure resource independence. The modern portfolio strategy requires a high level of conviction. It involves pairing high-growth AI stocks in the public market with the income defense of tokenized private credit and real estate. True diversification now requires a strategy that crosses into entirely different alternative asset classes. Simply holding a basket of public stocks is no longer sufficient to manage the risks of this cycle. Wealth in 2026 will not be generated by passively riding the economic wave. It will be built by those with the agility to actively navigate the treacherous currents moving beneath it.